Investing in the stock market can be intimidating to new investors. However, with proper guidance, knowledge, and resources, anyone can become a successful investor. Hi, my name is Lulu, and in this video, we will discuss some stock market tips that can help you make intelligent decisions and maximize your returns. We will also explore the benefits of being an informed investor and how to use the best available tools for trading. Finally, we will discuss some strategies that professional investors use to improve their chances of success in the stock market. Don't forget to like, share, and subscribe if you find it helpful. Be brutally honest with your trades. It is important for traders to be brutally honest with themselves in order to be successful in the stock market. Being honest about your strengths and weaknesses will help you make informed decisions that will yield consistent profits. Furthermore, being honest about your trades will allow you to track your progress and make adjustments if necessary. By being honest, traders can ensure they are making decisions that are best for them and their long-term success in the stock market. The trading process starts with understanding what you know about the market. This can be classified into three broad categories: general knowledge, specific knowledge, and experience. Then there are your personal experiences that are observational. These experiences can help to give traders an additional perspective on the stock market and allow them to make better decisions as a result. The next step in the trading process is to determine what trades you want to take based on your individual goals and risk tolerance for the day or week ahead. The final step in the trading process is to execute your trades once they have been determined, which might be when prices reach a certain point. Be choosy with each stock. Investing in the stock market can be a great way to build wealth over time, but it is also important to understand that stock selection is critical if you want to succeed. Being choosy with each stock you choose will ensure that you are buying into companies that have strong fundamentals and potential for growth. This will help you beat the stock market and make sure your investments perform well over the long term. Here are some of the basics about stock selection that you should know if you are just starting out in investing. Some tips for stock selection. Choose companies that generate consistent growth year after year. Look for companies that have strong products or services and are able to provide customers with the most effective tools. Look for companies with strong management teams who show innovation and creativity in their marketing strategies. These will be the best choices for your business in the future. Look for companies with strong management teams who show innovation and creativity in their marketing strategies. These will be the best choices for your business in the future. Choosing a company to invest in is not as simple as looking at its stock price, and you should never rely solely on numbers when making these decisions. Do your research before you put your money down, but remember that there is no right or wrong way to make this type of decision. Don't be a jack of all trades. It is important to not be a jack of all trades when trying to beat the stock market, as this strategy has proven not to be effective in the long term. Focusing on specific areas of knowledge and investing in those rather than spreading resources across multiple industries, investors can increase their chances of success while mitigating risk. Additionally, specialized knowledge allows investors to make decisions that are more informed and understand the implications of their investments better. As mentioned above, individual investors should only invest in what they understand and what they are passionate about. This is the path that has led to the highest amount of success for investors, as it is easier to invest in something you are knowledgeable about and passionate about rather than jumping into something with which you have no knowledge or interest. In addition to expert knowledge and specialization, it is important for individual investors to diversify their investments. This is a simple investment strategy that anyone can implement with little understanding of the stock market. The theory behind diversification is that by investing in multiple securities, stocks, bonds, and or mutual funds, investors are less likely to incur huge losses on any one security and therefore will be better able to weather the ups and downs of the market. As an investor's portfolio becomes more diverse, they increase their chances of not losing too much money in a single crash or gain. Individual investors should also diversify across asset classes to increase returns and reduce risk. There is no way that any one investment strategy can protect the investor from the risks of both inflation and deflation. This is why it is extremely important for individual investors to diversify their investments across different asset classes, such as stocks, bonds, cash, commodities, and real estate. Understand how raw emotions affect your decisions. Making the right decisions in the stock market is a challenging task and can be very cumbersome. It requires an understanding of how human emotions influence decisions. Understanding how to differentiate between emotional and rational decision-making is critical for investors wanting to beat the stock market. It is crucial to identify and analyze raw emotions such as fear, greed, and hope, which can lead to improper decision-making. By recognizing these emotions before they take hold, investors can improve their chances of success in the stock market. Fear is an emotion that leads to a feeling of alarm, worry, or apprehension. It is often linked with the idea of avoidance. People may feel fear in anticipation of having to perform a task or face an unpleasant situation. Fear may cause cognitive bias associated with errors, such as confirmation bias and overconfidence. Cognitive biases can be caused by the way one interprets data and events, which can lead to biased decision-making. For example, someone who experiences fear may interpret positive news as being more likely than negative news because they are hoping for the best outcome possible. Another cognitive bias may be that people tend to overestimate the probability of rare events. In investing, this could lead someone who is experiencing fear to take more risks that have a lower chance of success. Nostalgia can be defined as a sentimental longing for the past. It is a type of homesickness in which people experience feelings of regret or wistfulness about an era in their life they experienced with fondness. These emotions make it difficult for investors to objectively evaluate whether an investment will provide a profitable return and are often accompanied by cognitive bias, such as overconfidence or confirmation bias. For example, if someone is nostalgic for their childhood, they may have a bias for more risk-taking and making the most of returns because they could not experience the loss of money, which is a natural consequence for investors. Nostalgia can also be considered a psychological need. In general, it consists of memories from one's childhood or adolescence that are associated with positive feelings such as happiness or love. This process relies on cognitive biases in order to retrieve these memories more easily and increase the emotional connection to them. When people are nostalgic and feel comfortable reminiscing about their past experiences, they may perform less well by disengaging from current problems and being more readily distracted. Invest with an open mind. Investing in the stock market has become increasingly popular in recent years. With the right information and strategy, it is possible to beat the market and make money. However, it is essential to invest with an open mind if you want to be successful. Understanding the importance of investing with an open mind can help investors make well-informed decisions and maximize their potential returns on investments. It is also important to remember that some risks are inherent when investing in stocks, so it is wise to manage them accordingly. The stock market is open 24 hours a day, and the trading floor is always busy. It seems like stocks are flying off the shelves. This market behavior can be confusing for investors who are not familiar with stock investing and may lead to poor investment decisions if they are not careful. It is important to remember that this volatility does not mean that you should take risks, but instead, make informed decisions by managing risk accordingly. Remembering these key points when it comes to investing in stocks can help investors make a more informed decision about what leads them to successful investments and an open mind when it comes to risk-taking, while still keeping a clear head about their finances. Thank you very much for watching.